is current account balance, and then these
liabilities
trade
which
payable.
were taken over.
You see whether our statement of financial position will
and
balance.
then this purchase consideration, you can see that account is still supposed to be
our statement of financial position
the
balance.
Purchase consideration. The purchase what? Consideration. So those are basically the three items which you record in this account. And then from there, we balance this account. And I hope you can see, if you can be able to recall what you did in a FAR, that topic
is
of converting
of financial position balancing.
There is no much difference here. There is no much difference. So the balancing figure on this side.
So it should balance always the figure of 27.
Any balancing figure on this side
296
is basically a capital
700.
Is a capital
700. 700.
This one will be
700. I hope that is correct. I hope that is correct.
In the statement of financial position of the new company.
That is correct. Maybe you can just
this one is an asset. And then a capital reserve
that is
one is
okay.
recognized as a component of.
Is it balancing?
As a component of what? Equity.
Eunice,
component of
Benson.
Equity. So therefore, this basically how we account for the external reconstruction, merger, or basically what? Absorption. So first of all, we have to make a set of accounting entries to cross off the books of accounts.
So that is confirmed
the company or the selling company. Then make
so
another
we
set
are
of
basically done with the accounting for the admission of a new partner. So next, I want us to move on how do we account for the
particular question
retirement, or in other terms, how do we prepare financial statements of the partnership in case we have
those questions of converting partnership business
a partner who is retiring. We have a partner who is retiring. So let's look on this.
Not give you the
let's look on this. Let's look on
a
gain of the asset, because maybe when a gain of the asset, because maybe when the partnership business was started, the number of assets which were acquired, but basically those assets have increased in value. So that partner who is retiring basically should also get a share of that valuation.
So the valuation
gain. So therefore, once a partner is retiring, just like what we have said in case of admission, two things will happen. The goodwill will have to be valued, and basically that partner must get a share. And then number two, the asset will be valued.
Then we have
in
the
terms
other
of how we
method,
account for the valuation of assets,
how we account for the to compute the
goodwill is basically the same with how we account for those two assets
taken over
in case of admission. So once the goodwill has taken valued, one, we debit the goodwill account, and two, we credit the partner's capital account.
So that
using the old profit and loss sharing ratio. That goodwill should be written off immediately. We debit the partner's capital account using the new profit and loss sharing ratio, and then we credit what
is
any valuation gain or loss will be shared among partners using the old profit and loss sharing ratio. That is the same thing.
The net payment method here
happens,
that
is the same thing which happens whenever you have a new partner who is admitted. Now, on the other hand,
to the shareholders,
the partner who is exiting from the partnership business will only be entitled to the share of profit, will only be entitled to interest on capital, and maybe the salary to partners from up to the date he retired, up to the date he retired. So that's why it is also important to note that when preparing the statement of profit or
and other financials of the old company. So once the new company acquired the business assets and liabilities of the old company, the shareholders of that old company, the other financials like the debentures holders will be paid. In this case, they are usually paid by the new company in terms of being issued with the shares and maybe debentures free of charge. Like in this case, we'll be told that Company X here was liquidated, its assets and liabilities taken over by a new company, maybe called Company Y. So in this case, you'll be told that this company made a payment to the shareholders of this company, and that payment was in form of shares. The shareholders of this company were issued with the shares, they were issued with the debentures. The examiner will not have given you the specific shares, the specific debentures which were issued is upon you to compute. And basically the computation of that I'm saying here, usually take a lot of time. You compute the value of the number of shares, the value of the debentures which were issued. By the end of the day, you add the value of the shares issued to the ordinary shareholders, the value of the shares issued to the preference shareholders, the value of the shares and maybe debentures issued to the debenture holders of this company. You combine all that. So whatever you get by the end of the day is the purchase consideration. So if you check on all the questions now which have been tested, they require now you compute the purchase consideration using this method, the net payment method. The net payment method. So basically that is it. That's what you need to know as far as this is concerned. And actually this is an area which was examined last sitting. So meaning that the chances of this being repeated again is very slim. Very, very slim. Very, very slim. So in fact, we will start with that question which was there last sitting. That is a question we will start with. The question for April of 2025. And basically this was the question number what? This was the question number 4. Usually these questions for external reconstruction, these are questions always for 20 marks. For 20 marks, they are questions carrying 20 marks. 20 marks. So that is the question number 4. Question number 4. So therefore, what I want us to do, I want us to just take a small breather, a breather of 5 minutes, or we can just take a breather of 7 minutes. We come back at exactly 5. And basically make sure you have this question with you as we come back, So let's take that small breather of 7 minutes, and then we come back exactly at 5, so that we start this question here. So see you after that short break. Yes, so the question reads, 𝐂𝐲𝐬𝐧𝐥𝐢 Limited, a private company, has been experiencing dwindling sales in the recent years, largely due to stiff competition. The company directors, who are also the main shareholders, would like to transfer the assets and liabilities of 𝐂𝐲𝐬𝐧𝐥𝐢 Limited to a newly formed company, 𝐂𝐲𝐬𝐧𝐥𝐢 Limited, with effect from 1st of April 2025. The following is the latest statement of financial position of 𝐂𝐲𝐬𝐧𝐥𝐢 Limited as at 31st of March 2025. We have assets there, equity and liabilities down there. We then have additional information number 1 all the way to note number 8. What are we required to do here? We're required to prepare the following ledger account, close off the books of account of 𝐂𝐲𝐬𝐧𝐥𝐢 Limited, realization account, the preference shareholder salary members account, the ordinary shareholder salary members account. Part B, we are required to make the journal entries in the books of 𝐂𝐲𝐬𝐧𝐥𝐢 Limited to record the acquisition of 𝐂𝐲𝐬𝐧𝐥𝐢 Limited. No narration not required. And then part C, we are required to prepare the opening statement of financial position. So this question basically was a very simple one. This basically a question once you come across this question, then you should be assured that you have 15 marks with you. So basically, from the information we have in the first paragraph, we are told the company, which is called 𝐂𝐲𝐬𝐧𝐥𝐢 Limited, is a private company. This company has been experiencing dwindling sales. The sales have been reducing due to competition. The directors of this company in paragraph 2, who are also the main shareholders, want to transfer the assets and liabilities of this company to a new company, which is called what? 𝐂𝐲𝐬𝐧𝐥𝐢. So meaning that this company, which is called 𝐂𝐲𝐬𝐧𝐥𝐢 Limited, basically this is the old or what? The selling company, which basically will be liquidated and then transfer its assets and liabilities to a new company to be known as 𝐂𝐲𝐬𝐧𝐥𝐢 Limited. 𝐂𝐲𝐬𝐧𝐥𝐢 Limited, therefore, is the new, in other terms, the purchasing what? The purchasing company. That is the first thing which you need to understand from that particular what? Question. Now, we have said, how do we account for this? Because this is basically an external reconstruction. This is an external reconstruction. How do we account for this? We have to close off the books of account of 𝐂𝐲𝐬𝐧𝐥𝐢. And basically, that is what is required in part A. We prepare the books, or we close off the books of account of 𝐂𝐲𝐬𝐧𝐥Ee, and then in part B, we are required to make the journal entries to open the books of account of the new company 𝐂𝐲𝐬𝐧𝐥Ee, and then from there, we prepare the statement of financial position of the new company, which is called what? 𝐂𝐲𝐬𝐧𝐥Ee. I've said these questions are very simple. The only challenge with this particular question is the computation of purchase consideration. That is what only give you headache. But if, for example, you're doing this question in an exam, we advise you not to compute the purchase consideration. But because this basically we want to understand how we do this one, we have to compute the purchase consideration, and then maybe during our revision, I'll be able to show you the shortcut of doing these particular questions without necessarily computing the purchase consideration. So therefore, the first thing I want us to compute here, because that is the only item which we compute in these particular questions, is the purchase consideration. This purchase consideration, I've said, is computed using the net payment method. The net payment method. So recall we have said under the net payment method, we add the payment which were made to the shareholders of this company and the other financials, including the debenture holders. That payment is in form of shares. That payment may be in form of debenture. We add the payment which was made to them. So therefore, for us to be able to do that, what we do, we go to the balance sheet of this company. Can we go to the balance sheet of this company, specifically at the equity? The main objective here is to know the shareholders of this company. Was this company having the ordinary shareholders and the preference shareholders? And then we go to where we have non-current liabilities. We see who are the other financials of 𝐂𝐲 Limited. Can we go to, first of all, to equity? So if we go to the equity section, you'll be able to see this company had issued ordinary shares. The company also had issued preference shares. Then, what about the non-current liabilities? Do we have non-current liabilities? No, no, no. In fact, therefore, this question, therefore, is very, very simple. So what we need to do here, and I hope you can see our figures are given in thousands of shillings, So we will determine the payment which was made to the two categories of shareholders. We determine the payment to ordinary shareholders. Which payments were made to the ordinary shareholders? And also we determine the payment to the preference shareholders. So when this company, when the assets and liabilities of 𝐂𝐲 Limited were taken over by Tobbins Limited, so which payments were made to the ordinary shareholders and the preference shareholders of this company by the new company? Now, that information about the payment is always given in the additional information. Can we go to the additional information number 1? Let's go to the additional information number 1. We need to move together here. So in note number 1, you're told the authorized share capital of Tobbins Limited, that is the new company, comprised of 100 million shillings, 100 million, comprising of ordinary shares of shillings 10 per value. So that is all about the authorized share capital of the new company. Then note number 2, we are told Tobbins Limited. Remember, Tobbins is the new company. Tobbins is the one which is to pay the shareholders, the ordinary shareholders and the preference shareholders of 𝐂𝐲. So we are told in number 2, Tobbins Limited issued new ordinary shares in favor of the preference shareholders in 𝐂𝐲 Limited on the basis of 3 new ordinary shares for every 5 preference shares which were held. And then let's move to the other sentence. We are told the ordinary shares were credited at 6 bob. I will be able to explain what you mean by that. And the preference shareholders in 𝐂𝐲 Limited were to pay up the balance immediately to make their shares fully paid. So in that case, what you are given here, in that point number 2, are the ordinary shares which were issued by the new company. The ordinary shares issued by the new company to who? To the preference shareholders. To the preference shareholders of this company. So meaning that is a payment which was made by Tobbins Limited to the preference shareholders. So we will come here and basically we determine the number of ordinary shares, or actually we will come here and we determine, don't write that first of all. We will come here and we determine how many ordinary shares were issued to the preference shareholders of 𝐂𝐲 Limited by this company. So that is something we have to compute. Let's go back to point number 2. We are told Tobbins Limited issued new ordinary shares in favor of the preference shareholders of 𝐂𝐲 on the basis of 3. On the basis of 3, this is basically how we put it. On the basis of 3 new shares for every 5, a bit together, for every 5 preference shares which were held. It basically means that this company was to issue 3 ordinary shares for every 5 preference shares which were held. So for us to be able to determine the ordinary shares which were issued by the new company, we need to multiply this with the number of preference shares, with the number of preference shares which were held in which company? In this company here. In this what? A company. So first of all, can we determine this? The preference shares issued by 𝐂𝐲𝐬. So where do we get that? We go to the balance sheet of 𝐂𝐲𝐬, specifically at the equity, and I hope you can see the preference shares. They have a value of what? 45. How do we get the number of shares? We're going to divide that with what? To get the number of preference shares issued by 𝐂𝐲𝐬 Limited. We will take 45,000, we divide that with what? We divide that with what? We divide that with the par value. We divide that with what? The par value. Is that the case? Is that the case? Please give your answers here. Give your answer in the chat box. This one will be divided with what? We want to know the preference shares issued by 𝐂𝐲𝐬. We have taken its preference share capital. We divide that with what? With the 10. So meaning that the preference shares issued by 𝐂𝐲𝐬 were 4,500. So therefore, we are told the new company, 𝐁𝐽𝐻, was to issue 3 ordinary shares for every 5 preference shares which were held. So we need to multiply that with 4,500. So this will give us the ordinary shares which were issued by the new company. You can use a wrong approach of doing it. So because we are told the new company was to issue 3 ordinary shares for every 5 preference shares which were held. This is a wrong approach of doing it. For every 5 preference shares which were held. And then we know that the preference shares which were held were 45. You cross multiply, then you divide. 3 times 45 divided by 5. You can see by the end of the day is the same with what we have here, but I'm saying this is a wrong approach of doing it. A wrong approach of doing it. So just work with this. So here we will get what? I'm told this will give us 27. 27. Is that what you're getting? This is saying what? This is saying, sorry, Morima, the question is not calling it share capital. It's not calling it share capital. Which one? What are you referring to? This. Okay, so let's take that point again. You need to understand the point first of all. So we are told 𝐁𝐽𝐻 Limited, which is the new company, issued new ordinary shares in favor of the preference shareholders of shareholders in 𝐂𝐲𝐬 Limited. 𝐂𝐲𝐬 Limited. In other terms, the new company, which is 𝐁𝐽𝐻, was to issue ordinary shares to who? To the preference shareholders. That's basically what you're told. On the basis of what? On the basis of 3 new ordinary shares for every 5 preference shares which were held. So you just need to understand that the new company was to issue 3 ordinary shares for every 5 preference shares which were held. For every 5 preference shares which were held. In this case, we are saying, for you to be able to determine the ordinary shares issued by our new company, you must determine how many preference shares had been issued by the old company. That's why we are taking the preference share capital of 𝐂𝐲𝐬, dividing that with the 10 to get the number of preference shares which were held. Are we together? You must understand that list. Yes. So therefore, no, automatically 45,000, these are not shares. List. Are these shares? These are not shares. These are not shares. This is basically share capital. This is share capital. For you to know the shares, you divide that with the par value. That's why we are dividing that with the par value. 45,000 here, they are not shares. Whatever is recorded in the balance sheet are the share capital, not the shares. We record the value of the shares, not the shares. Yes. So this one will give us what? This one will give us 27. Is that the case? Is that the position? Is that the position? Yes, because that will give us that. So meaning that here we say that the preference shareholders were issued with 2,700 ordinary shares. And in that case, there is another point which are given very, very important in the last paragraph of note 2. We are told the ordinary shares were credited at 6, and the preference shareholders in 𝐂𝐻𝐧𝐥𝐢 Limited agreed to pay up the balance to make up the shares fully paid. It basically means that these preference shareholders were issued with shares. Why are they issued with the shares by the new company? They issued with the shares by the new company as a form of payment. But now the agreement is that the new company is not issuing the shares, is not issuing these particular shares as fully paid. So we are told they are credited at 6. So meaning that these shares which were issued to the preference shareholders, they are issued for free to an extent of 6 bob. To an extent of 6 bob. If you can be able to remember in note number 1, what is the par value of the shares of the new company? The shares of the new company, which is Tobins, they have a par value of what? The ordinary shares, as per note number 1. They have a par value of what? They have a par value of 10. Can you see that in note 1? They have a par value of 10. So, but now, when the preference shareholders were issued with these shares, the shares were not issued to them 100% free. 100% free. They were issued, those shares were issued to them for free to an extent of 6 bob. They are not required to pay 6 bob. That is a payment made to them, but automatically they will have to pay the balance. The balance will be what? The balance they will have to pay to the new company will be 10 shillings minus 6. They will have to pay the new company 4 shillings per share. But now this amount to be paid, this basically we will account for it in the books of account of the new company. So this is an amount to be paid to the new company. So that one will be accounted for when opening the books of account of the new company. So what we're interested with here is the value of the shares which were issued free. So the value for the shares which were issued free will be the shares which were issued times the amount they were not required to pay per share. This is basically the payment which was made to them. So this will give us what? This will give us 16,200. 16,200. So the shares which were issued to them free of charge as a form of payment had a value of 16,200. Had a value of 16,200. Is that understood? Before we move to something else, is that understood? Is that understood? Yes or no? Is that understood? Is that understood? Yes. So let's then move to the other note. Note number 3. We are told the preference dividends in 𝐂𝐻𝐧𝐥𝐢 Limited were 2 years in arrears, and the new company issued 540,000 fully paid ordinary shares of shillings 10 each as a final settlement of the arrears. So the first thing we need to compute here are the preference dividends in arrears, because we are told this company here had not paid dividends for 2 years. The preference dividends in what? In arrears. So how do we compute the preference dividends in arrears? We get the information from the balance sheet of 𝐂𝐻𝐧𝐥𝐢, specifically under equity. So the preference shares issued by 𝐂𝐻𝐧𝐥𝐢 were 12%. 12% means that this company in each financial year should pay dividends equal to 12% of the preference share capital. The preference share capital is 45,000. So this is the preference dividend to be paid annually, but we are told these dividends were in arrears for 2 years. So we multiply this with 2. We multiply that with 2. So that will give us what? That will give us what? This will give us what? This will give us, are you getting that amount there? Is that what you're getting? Yes, yes. So that now will give us an amount of 10,800. So these are the preference dividends in what? In arrears. The preference dividends in arrears. Now we are told, remember this basically an amount of money which was owed to the preference shareholders. They were supposed to be paid this amount because their company has been purchased. They were supposed to be paid this amount. But now in note number 3, we are told the preference dividends in 𝐂𝐻𝐷 Limited were 2 years in arrears, and the new company issued 540,000 fully paid ordinary shares of �10 each as a final settlement. So in that case, what we need to do is basically to determine how much amount was paid to the preference shareholders as a result of these preference dividends which were in arrears. In this case, we are told the preference shareholders still here, they were issued with 540. Remember, we are working with our figures in thousands of shillings. So those shares, we take them as 540. We omit the last 3 zeros. They were issued with 540 ordinary shares, and basically those shares we are told they were issued as fully paid. As fully what? Paid. So that's why now we are using the value of 10 shillings. They were fully paid. So and basically this will give us what? This will give us 540. So it basically means that out of this amount, the preference shareholders were just paid 540. They were paid 5.4 million. Out of 10.8 million, they were just paid what? They were just paid 5.4. It basically means that the difference will be a loss covered by them. The difference will be a loss which was covered by them. So what we account for here is basically the payment. The payment. They were paid an amount of 5.4. It was not paid to them in cash. They were issued with the shares free of charge as a form of what? A payment. So if that is well understood, I want us to move now to point number 3. In point number 3, we are told that 𝐁𝐿 Limited, which is basically the new company, issued a new ordinary shares in favor of the ordinary shareholders in 𝐂𝐿 Limited on the basis of 2 new ordinary shares for every 5 ordinary shares which were held. In that case, those are the ordinary shares which were issued by our new company to who? To the ordinary shareholders. So in this case, we need to determine how many ordinary shares were issued to the ordinary shareholders. Very simple, because we are told, we can take that point again, we are told, 𝐁𝐿 Limited issued new ordinary shares in favor of the ordinary shareholders of 𝐂𝐿 on the basis of 2 new shares for every 5 shares. That's how you put it. 2 shares for every 5 shares which were held. In this case, just like what you have done down here, we need to multiply this with the number of ordinary shares which were held in this company. The number of ordinary shares held in 𝐂𝐿. How do we determine that? We go to the equity section of the balance sheet of 𝐂𝐿, and we take the ordinary share capital, which is 80,000. We divide that with the par value per share, which is 10. That will give us the ordinary shares issued by who? The ordinary shares issued by this company. And because the new company was to issue 2 shares for every 5 shares were held, we multiply that with this. And we determine the number of ordinary shares which were issued by the new company to the ordinary shareholders. I've said if you can't be able to understand this approach which Mwalimu is using, you can use the wrong one, this one. You can use this is the wrong approach. The wrong approach means, or we are told using this the wrong approach, which by the end of the day will take us back here. We are told the new company was to issue 2 ordinary shares on the basis of 5 ordinary shares which were held. In our case, we know the ordinary shares which were held were 8,000. You cross multiply, then you divide. It will take us back to this 2 times 8,000 divided by 5. The same with this. So avoid this. This is the wrong approach. Use this one. So this will give us what? This will give us 32. Then we need to know how are these shares issued. Were they fully paid? Or maybe the shares were issued for free to a certain extent. So we are told in the same point, the other sentence, these ordinary shares were credited at 4 shillings, and the ordinary shareholders in 𝐂𝐿 Limited committed to pay the balance to make their shares fully paid. So the shares which were issued to the ordinary shareholders were 32 ordinary shares, and in this case, we are told the shares were issued for free to an extent of 4 bob. So they will have to pay the new company the balance of 6 shillings, which basically we have said is an accounting entry in the books of account of the new company. So this will give us what? We take the shares times this. And that will give us what? That will give us 12.8. Now, I'm saying this question was very simple because these are the three items you just needed to compute. We don't have any other payment which was made, just those three. But now, in this case, there is also something else we come and we add here, the liquidation cost. Remember, in this case, we have said that this company will be liquidated. This company will be liquidated. Mostly the liquidation cost, which is incurred by this company, is paid by the new company. Once it is paid by the new company, that will be part of the purchase consideration. That will be part of the purchase what? Consideration. That information is usually given in the last three points. So you'll be able to see this in all questions for external reconstruction. Like if you go to the last 3 points, point number 6, 7, and 8, you must be given information about that. So, and that information is note number 7. The liquidation expenses of 𝐂𝐻𝐧𝐥𝐢𝐧𝐞 Limited, that one, amounted to 12.8 and were paid by Tobins. That is always the information will come across in all questions for external reconstruction. So that liquidation cost, it is also considered as part of this because it was paid by the new company. It was paid by the new company. So then what we need to do is basically we add all this, we get the purchase consideration. Give me the total here because I want us to do at least part A, even if we will not be able to finish, but we can be able to finish. I feel that we can be able to finish because that is basically the only part which was a little bit tricky. So give me that total there. Give me the total, and then we move now to the other part. So I'm told the purchase consideration here is 47,200. 47,200. 47,200. Now, having that, then what we need to do, can we go to part A? So this is the only requirement which is required. I want us now we move to part A of that question. What are we required to do? We are required to prepare the following ledger accounts to close off the books of holdings. Ledger accounts, accounts to close off the books of who? Of 𝐂𝐻𝐧𝐥𝐢𝐧𝐞 Limited, of 𝐂𝐻𝐧𝐥𝐢𝐧𝐥 Limited, of 𝐂𝐻𝐧𝐥 Limited. So, and in that case, you can see the ledger accounts you're required to prepare. There, the first one is the realization account. The realization account. The realization account. Realization account. Then we need to have the other account, which is the ordinary shareholders. Ordinary shareholders. Salary members account. Salary members account. Okay, that is the basically think Roman 3. Roman 4, that is Roman 2. We are required to prepare the preference shareholders, salary members account, salary members account. There is also another account we are going to prepare, though it's not part of the requirement there. Though it is not part of the requirement. And basically there is an account called purchasing company account. Purchasing company. The purchasing company is this one. Is this one, which is Tobins. Tobins Limited. Tobins Limited account. Tobins Limited account. So let's prepare this account together. I hope you already have that format with you. Yes. So let's prepare this account. Basically, I've said to prepare these accounts, or in other terms, to close off the books of account of the owned or the selling company is very simple. Very, very simple. So what you do, you go to the statement of financial position. Can you go to the statement of financial position of Collins? Let's go there. Let's go to the statement of financial position of Collins. So what do we do? You can see we are given asset, equity, and liabilities. We systematically close off those accounts without skipping any. Now we start with the asset. Now for the asset, I've said asset can either be taken over by the new company. There are those assets which were taken over by the new company, or the asset can be written off. That information, we have it somewhere within the additional information, specifically note number 5. Can we go to note number 5? Note number 5. In note number 5, we are told the asset of Collins, which is basically the owner of the selling company, was transferred to the new company at the following fair values. Which are those assets, including landed buildings, plant and machinery, motor vehicle, furniture and equipment, inventory, account receivables. So we go back to our statement of financial position. If we go to the statement of financial position, you'll be able to see all the assets, including land, plant and machinery, motor vehicle, furniture and fittings, inventory, and account receivables. All of those assets were taken over by the new company. So basically, we have seen those assets which were taken over by the new company, they are debited in this account at the net book value. The net book values are not the values we have in note number 5, but the values we have in the balance sheet. Those are the net book values. Sasa? Yes. So we don't use the fair values. So which are those assets which were taken over? Basically, I've said all of them. All of them. So therefore, we debit all those assets here. We start with the land and buildings. Land and buildings. And basically, in this case, the net book value is the values we have in the statement of financial position, 48,500. So then from there, we have the plant and machinery, which is 27,115. Below that, we have the motor vehicles. The net book value for that is 99,40. Below that, we have furniture and equipment, which is 40,260. And then we have now the current asset. Current asset include inventories. The book value is 10,550. And then below that, we have the account receivables. The account receivables, the book value for that is 73,70. So that's basically how we account for the assets which were taken over. And I hope you can see the values which you have used here are the net book values, the values we have in the balance sheet, not the values, not the fair values we have in note 5. Those values, we use them in the books of account of the new company. In case there was an asset which was written off, that asset should be debited here. There was no asset which was written off. So you can see we have closed off all the asset account. Then we go to equity. Equity, we have how many items? 4. The first one is ordinary share capital. Ordinary share capital, we record them in this account. And basically, ordinary share capital and the other reserves, they should be credited here, except losses. Accumulated losses should be debited here. So the ordinary share capital, which should be credited in this account, is how much? Is 80,000. 80,000. Remember, our figures are in thousands of shillings. So below that, we have 12% preference share. Preference shares should be credited in this account here, not this one. So we have the 12% redeemable preference share capital. How much is that? Is 45,000. 45,000. Then from there, below, I hope you can see there is nothing I'm skipping. I'm systematically crossing off all the account of Collins Limited. So below that is share premium. Share premium is a reserve. Being a reserve, we credit it in this account. How much is that? Is 4,000. Below that, I have losses. Losses, is a reserve, but these very losses, they have a debit balance. Losses should be debited in this account. Accumulated losses. Accumulated losses amount to 41,760, like that. Is there anything I'm skipping? No, I go to the liabilities. Current liabilities. Current liabilities, mostly these are taken over by the new company, but we need to confirm. So that one must be given as part of the additional information. Automatically is not part of the additional information number 1, 2, 3, and 4, because we have dealt with those additional information, not part of note 5. But if you go to note number 6, we are told current liabilities were taken over by the new company. So the liabilities which were taken over by the new company, we said they should be credited here. Which are those liabilities? We have account payables, which is still 605. And then we also have the bank overdraft. The bank overdraft. This one was still taken over. So can you see what you have done? We have closed off all those particular accounts which had balances. Now, then from there are three additional items which are not part of the statement of financial position. You must always remember to account for here. Three additional items. Which are those three additional items you must account for here? One is the preference dividends in arrears. Number 2, we must also account for the purchase consideration, which has been computed here. And 3 is the liquidation cost. I want us to start with this one. And I hope you can remember the preference dividends which were in arrears. We computed this. Was it coming to 10,800? The preference dividends which were in arrears. Please, someone to confirm. Are they 10,800? The preference dividends which were in arrears. Georgina, were they 10,800? Are they 10,800? Patrice? Phoebe? The preference dividends in arrears we computed, were they 10,800? Yes, they were 10,800. So how do we account for those preference dividends in arrears? We basically debit them in this account. We debit them here. Preference dividends in arrears. Debit them here, and then credit them in this account. Preference shareholders. Preference dividends in what? In arrears. 10,800. So we are done with that. So the other item which we also account for is the purchase consideration. Purchase consideration, this one, which you have computed here, we said that one should be credited in this account. The purchase consideration, which is 47,200. We credit it there, and then we debit it in this account. The account called purchasing company. The purchase consideration. The purchase consideration 47,200. 47,200, like that. So then from there, next we account for this, the liquidation cost. The liquidation cost, I hope you can remember, is this amount here. So this liquidation cost, I've said, it should be debited in this account, 12,800, and then credited here, credited in this account. So we have the liquidation cost. The liquidation cost is 12,800, like that. 12,800, like that. So basically, that's what we have. Then after doing that, next Next is basically to account for the payment of purchase consideration. That is the next thing we do. So the purchase consideration is basically the amount of money paid to the ordinary shareholders and the amount paid to the preference shareholders. So how much amount was paid to the ordinary shareholders? This is the amount paid to the ordinary shareholders. The amount paid to the ordinary shareholders, I said, this one should be debited here. This is the purchase consideration. The ordinary shareholders were paid 12,800. So you debit that here, and then you credit it in this account. You credit it in this account. So the other entry here is in the ordinary shareholders, salary members account, which is, okay, so this and this is the same, okay. So which is 12,800. Okay, so then from there, we account for the payment made to the preference shareholders. This is the payment made to the preference shareholders. Don't include this liquidation cost. This is the payment made to the preference shareholders. Can you add for me those two figures? These two figures here. Those two figures. They will give us what? 21,600. 21,600. Is that the payment which was made to the total payment to the preference shareholders? The total payment to the preference shareholders? Yes, that is the payment made to them. So how do we account for that? We debit it in this account, purchase consideration, which is the 21,600. And basically we do what? We still credit it in this account. So the other entry is in preference shareholders, salary members account. So which is 21,600. 21,600. And basically we are done now. We are done with the crossing of the books of account of the old company, which is 𝐁𝐋𝐿. So what we need to do is basically to balance this account. So in balancing this account, we start with the last one, this one. And this account I've said it should automatically balance. This account should not have any balance, this one. So that is something we need to confirm. We need to confirm with this account balance off. So just add whatever you have on the credit side. You add this one, it should be equal to this. This account should automatically balance off. Should automatically balance off. Is the account balancing off? What are you getting on the credit side? Yes, I'm told by Diana, it will automatically balance off. That should automatically balance off. Then these two accounts will not balance. This account, this and this one, they will have balancing figure. Basically, I've seen the balancing figure in these two accounts is basically a loss. If we are the shareholders of a company and we have sold our company, we can sell it at a loss or at a gain. So the balancing figure in these two accounts is a gain or a loss, and it should be crossed off to this account. Should be crossed off to this account. So let's start with this one. So can you add what you have on the credit? What do you have on the credit side? What do you have on the credit side? This one will be what? Will be 55,800. So basically, this amount which you have on this side, this is what the preference shareholders were supposed to be paid. They were supposed to be paid around 55.8 million. How much amount were they paid? They were just paid 21.6. They suffered a huge loss. They suffered a huge what? A huge loss. So that loss, we cross it off to this account. And basically, this one we take it to the realization account. Realization account, but basically this one I've said is what? Is the loss. Is the loss. How much is that? 34,200. So we cross it off to that account. We follow the rule of double entry. This account is debited, this account should be credited. So the other entry is in preference shareholders, salary members account, 34,200. 34,200. We do the same here. We do the same here. We do the same here. We do the same. We do the same. So the total on this side will be 84. So the total on this side is basically less. It means that we have a balancing figure equally on this side, which is a loss. A loss of how much? To the ordinary shareholders. A loss of how much? A loss, I'm told a loss of 29 for 40. A loss of 29 for 40. Is that what you're getting? Is that what you're getting? Is that what you're getting? Based on what you're asking about what? About what? There is nothing which is kept based on the accumulated losses are here. The accumulated losses are there. So now this basically amount we still cross it off to this account. So the other entry here is in ordinary shareholders, sundry members account 29 for 40. So once we are done with that, we are basically we are done. We are done with that question. So what we need to do is basically to balance this account. We balance this account. These accounts should automatically balance off. These accounts should automatically balance off. These accounts should automatically balance off. You add whatever you have on this side, whatever you have on this side that account should automatically balance off. Should automatically balance off. Should automatically balance off. Is our account balancing off? Is our account balancing off? Yes. So that is confirmed. Yes. So basically that is it. That what is required as far as part A is concerned. What you have just done is part A. Part A had how many marks? The realization account had 6 marks. Preference shareholders sundry members account 2 marks. Ordinary shareholders sundry members account 2 marks. So basically we have only done part A 10 marks. So automatically because of time we will finish that question in our next class. We will just make the journal entries. Journal entries in the books of account of the new company. And I've said that is quite simple. You first of all make journal entry for 3 items. The assets which were taken over. We know the assets which were taken over are all these. But when accounting for these assets which were taken over in the books of account of the new company, we account for them at their fair values. The fair values we have in note number 5. Are we together? You make the double entry. Debit the specific asset account, credit the business purchase account. Number 2, we will account for the liabilities taken over, and you can even attempt that even before you meet. The liabilities which were taken over are 2. Account payable bank overdraft. Credit the specific liability account, debit business purchase. Number 3, we account for purchase consideration, which you have computed here, which we say debit the business purchase, credit the selling company account. Then from there, after making those 3 journal entries, prepare a business purchase account. You determine whether Tobins Limited acquired the business of Collins at a goodwill or capital reserve. And then from there are other items you'll account for. For example, the amount which was paid by the ordinary shares, because you can see the ordinary shareholders were to pay 6 bob to the new company. That is money received by the new company. The preference shareholders were to pay 4 bob for these shares. You also account for that. That is basically what we will do in our next class. And then there is a question which was examined on merger. We will finish on this one, and then we do the question for merger. We do the question for merger, where 2 companies were being liquidated, forming a new company. That is the other question we will also be able to do, because finishing what is remaining here will not take us more than 30 minutes. So I want us to stop at that particular point, but I've said even before we meet in the next class, you can attempt what is remaining. In fact, what is remaining there, those 10 marks, those are just 3 marks. especially even in the last part, you prepare the balance sheet of the new company. You can see already you know the asset of the new company from note number 5. We just need to transfer them here. Sasa, yes, so we stop at that point for today. Have a nice weekend. We continue from here on Tuesday. See you then.
We are being told that 𝐶𝐂 PLC is a company registered for value-added tax, that is VAT purpose, buys and sells goods locally and in foreign markets. So the following transactions were extracted from the books of the company. We say for the month of September 2024. Number 1, that is September 2nd, purchase goods from local market for 103 to 40. So when you're told purchase goods from a local market for 103 to 40, what is that? Very fast so that we do it. What is that? That is an input VAT. So the next, we're being told that imported goods, we are being told that imported goods with a landed cost of 340, excluding what they call the import duty and value added tax, excluding what we call the import duty and value added tax. So the import duty was 25%. So we can have our first working on that. First working on that, we just say CFI, that was 340. So we have import duty, importer duty, and the CFI, input duty and the CFI, that should be, so this is 100%, this should be 100%, so the 2 should be 125. So we have 125 over 100 times 340. So what is the figure? What is the figure? What is our figure for that? That is 425. 425. So that is 425. 425. Then we move to the next. We're being told that sold goods on local market. Sold goods on local market for shillings 180, 960. Sold goods in the local market for shillings 180, 160,000. So what is that? That is an output fee, VAT. So then September 8th, we are told that paid audit fee of shillings, paid what we call audit fee of shillings 17,400 in respect to establishing what we call internal audit control. In respect of establishing what we call internal audit control, that should be an input VAT. Miriam, are we together? Are we together, Lenovo? Freda, are we together? If we are together, you respond with a yes. If we are together, you also respond with a yes. Thank you, Katar. Thank you, Freda. So then the next, we've been told that that is September 10th. September 10th. So we've been told that goods valued for shillings 20,880 were returned to the business. Goods valued for 20,880 were returned to the business by a credit customer, and a credit note issued immediately. And a credit note issued immediately. And you're being told, and the credit note issued immediately. What is that? And does it affect input or output? What is that? It affects output. How does it affect output? T and Mary paid for catering expenses. That is shillings 20,880. 680, sorry, in respect to a restaurant facility managed by another firm. So what did you say about catering services? Those are non-deductible input fee, non-deductible input VAT. So then we move to the next. We're being told that sold goods, that is September 14th, we're being told that sold goods to a firm operating in Egypt. Sold goods to a firm operating in Egypt for shillings 480. Sold goods to firm that is operating in Egypt for shillings 480. For shillings 480. What is that? So that is an export. Exports are zero rated. So remember that is an export, and exports are zero rated. So that is an export, and we understand that that export is zero rated. So then we move to the next. We're being told that received what we call a debit note of 62,640 in respect to erroneous invoice received earlier. So being told that pay received a debit note for shilling 62,640 in respect to erroneous invoice received earlier. So what is that? And what does it affect? That is a debit note received. And it affects what? Input, which is purchases. The examiner tells us September 18, exported goods to Malawi. Exported goods to Malawi. We have exported goods to Malawi, valued at shillings 240. When you say exported goods to Malawi, valued at shillings 240, how do you treat it? Valued at shillings 240. That is an export, and that is zero rated. So the next, that is September 20th, the examiner tells us that purchased computers and computer softwares for shillings 208,800 for use in business. For shillings 208,800 for use in business. How do you treat that? That is an input. Input, for those who are not in class, input is VAT on purchases and expenses. So then the next we say supplied and processed. Supplied what we call and processed fruits and milk to Starlight Enterprise for shillings 170. So being told that the supplied what we call and processed fruits and milk to Starlight Enterprise for shillings 170. What is that? Remember that is sales, but that sales is exempt. That is exempt. That, remember that is exempt. Together. Remember that is exempt. So then the examiner tells us that is September 24th, sold goods to Lucky Enterprise. You're being told sold goods to Lucky Enterprise for shillings 64,960. For shillings 64,960. For shillings 64,960. What is that? Sold goods to Lucky Enterprise for shillings 64,960. Aziz, how do you treat that? Aziz and Ann and FJ, how do you treat that? For shillings, how do you treat that? That is an output. That is output. Thank you. So then you're being told that purchased oil and fuel. You're told that purchased oil and fuel of shillings 9,280. Of shillings 9,280 for a generator used in business. For a generator, we say used in business. For a generator that was used in business. How do you treat that? For a generator that was used in business. So that is input. At what rate? Remember, as of 30th, that is June 2023, oil and fuel changed from 8 to 16 to 16 at the rate of 16. I'm saying as of 30th, are we together? As of 30th, as of 30th, that is June 2023, oil changed from 8 to 16. Perfect. Thank you, Aziz. Noted that. Then say a customer owing a business goods worth 20,300 was declared bankrupt and the bad debt was written off. And the bad debt was written off. How do you do that? And the bad debt was written off. And the bad debt was written off. What did you say about that? What did you say that? That basically reduces what's called the output. Output, that will reduce the output. Then lastly, we have what's called sold goods exempt from VAT. So being told that sold goods exempt from VAT for shillings 250,000. What is that? Sold goods exempt from VAT, shillings 250,000. That touches on output, but that is exempt. So then the examiner tells us all transactions, examiner tells us that all transactions are inclusive of value added tax, that is VAT, where applicable. VAT, where applicable. As this says, let me. For tax, this is real time. When changes are effected, what you do is real time altogether. If it's a day before 30th, then that should be 8%. Otherwise, from 30th, that is July, that should be 16%, 16% altogether. As per day. So anything less than 30th, that should be 8%, 8% together. 8%, 8%. 8%, 8%. And I want you to also note that tax changes a lot. Have you noted that tax changes a lot? What we're learning today, the number of things that will not apply. What you're learning today in the next 2 years will have different rates, or there will be a lot of changes altogether. For tax, it changes a lot. We can have something in operation, somebody goes to court, and the next day it doesn't exist. Have you ever noted that? We are applying something, and the next day it no longer exists. Is it true for tax? That is tax for you. Things will keep on changing. Believe me, what you're learning today, there will be changes to it. Is it true, Aziz, and the rest of the team? Perfect, that is true. So then, we move to the next, it's all calculate the value added tax, calculate the value added tax payable or refundable. Calculate the value added tax payable or refundable to 𝐂𝐾o PLC for the month of September. For the month of September. We did say that in questions where we have exempt, and we are not told that those exempt purchases that were sold were as exempt could not be traced. We are not told whether they could be traced. Which method did you say we are going to use in this particular question? Which method did you say we are going to use in this particular question? Are we going to use the direct method where we are going to restrict? So we proceed. We can start with the input for the start. We start with the input. We can start with input. So we start with the input. Input. So we have item. We can have item. You can also include the date if you want. You have the date, the amount. Then you have the VAT rate. Then we have the VAT. So we start with the input for this question. We start with the input. So the first one on the input, we say purchases. We have purchase, local purchase, local purchase. What is the figure for the local purchase? The figure is 103. to 40. Which rate are we using? And why are we using that rate? Which rate are we using and why are we going to apply that rate? 16 over 116. Frida, I think you've forgotten 16 over 116. We are not getting self-exclusive. Yes, I'm increasing the fonts. Let me repeat it again. Let me just increase. Local. I hope now it's okay, my good brother. So 103 to 40. The rate is 16 over 116. And why are we using 16 over 116? 116 over 116? Why are we using that? So that others can also understand. Because we've been told all transactions are inclusive. All transactions are inclusive of value-added tax. So what do we have? All transactions are inclusive of value-added tax. So we have 14. That is 14 to 40. 14 to 40. Then we proceed to the next. We have what we call import. What is the value of import? The working that you did. The value for the import from the working, 425. What do you say about import? Imports are exclusive. So that's we use 16 over 100. Even if the question is inclusive, imports are normally exclusive. So what is the value of that? Provide that for me. 16 over 100, what do we have? So that should be 68. 68. Then we go to audit fee paid. We have next is audit fee. So for audit fee, we have a figure of 17,400. We have 16 over 116. So what is the VAT on audit fee? The VAT on audit fee. The VAT on audit fee. Meanwhile, as you make the entries, the scores you're getting, as you make right entries, you're scoring marks. So then we'll move to the next, go to catering. Catering is a non-deductible catering services. So this is non-deductible. This is non-deductible. That is non-deductible input VAT. So then we proceed to the next. We have debit not received. Debit not received. We have the debit not received. And the figure for the debit not received is 62,640. So that is 16 over 116. What is the VAT on debit not received? What is the debit not? Debit not received, the VAT on debit not received, we have it as 8640, 8640. Then we proceed to the next. We have computer and computer softwares. The next purchase or expense is computer and what we call computer softwares. And computer softwares. Computer and computer softwares, we have 208,800. So that should be 16 over 116. 16 over 116. So what is that? I'm going back there. 14th is output. Sheila, Lenovo, I'm on input. Input is purchases and expense. 14th, that should be on sales. Sawa. So we have 28. Somebody says 28,800. Together, 28,800. So then if we proceed to the next, we have oil and fuel. We have oil and what's called fuel. Oil and fuel. We have 92,80. So times 16 over 116. So that is 12. We have it as 12,80. So then I hope there's no input. There's no input. So what is the total input? Total input VAT. So what is the total input VAT? What is the total input VAT? Check that 10. So that affects sales. Goods valued at 20. Good valued at 20,000 were returned to the business by credit customer. That affects the sales. Okay. The 10 that affects the sale, return inwards. That is return inwards. And the credit note was issued. Okay. Credit note issued affects sales. Remember, when you're doing the restriction, we separate input and output. Okay, are you sorted? If that is sorted, you respond with a yes. Okay, is that sorted? So that should be 123. We have 123, 316. Perfect. So then you go to the output. Before we do the restriction, we get the output VAT. Is there anything on input that we've not given? So we have everything on input. Is that correct? Everything on input is sorted. We respond with a yes if that is sorted. Perfect. So I go to the sales. We have the first one. We have the items. Can you see here? Items. We have amount. We have the VAT rate. And then we have the VAT. Are you able to see the board perfectly well at that point? I hope you can. So then we have what we call local sales. So the local sales, we had a figure of 180, 960, the VAT rate is 16 over 116. So what is that? The VAT rate is, so that should be 24. We have it as 24, 960. Perfect. So then we move to the next, you're being told the next is credit note issued. So we have what's called the credit note issued. So what do you call the credit note issued on goods that were returned? So the credit note issued, that was 28,80 times 16 over 116, and that will less. So what do you have? That figure that you're lessing. What is the figure that we are lessing? The figure that we're lessing. Provide the figure that you're lessing. 28,80. Is it right? What has been given? Which one is right? Is it Sheila or 28? That should be 28,80. Then you have the next. The next is export. Export. We have it Egypt. Export Egypt. That should be 480. So that is zero rated. So this should be zero. You must write a zero, not a dash. Zero and a dash are two different things. The dash means exempt. So we move to the next, we have what's called export Malawi. We have export, and we understand that goes to Malawi. So Malawi is 240. So we have 0 to 40. Then we have 0. Then we move to the next. We have what we call supply of unprocessed. So we have the unprocessed fruits and milk. Remember, these are exempt. These are exempt, the figure 170. Though there's no entry for this, but that is exempt. Everybody together with me? Are you together with me? If you're together with me, give me a yes. If we are together, then you give me a yes. Perfect if you're together. So then we proceed to the next. We have what we call Lucky Enterprise. We have what we call Lucky, another style, Lucky Enterprise. So Lucky Enterprise, we have a figure of 69, 64, 960. And then we have a 16 over 116. What is that output VAT? What is the VAT for Lucky? Lucky, what is the figure? Lucky, we have 89. We have a figure of 8960, that is for Lucky. 8960 for Lucky. So then next we have, that was a customer owing the business goods worth 20,300 was declared bankrupt, and the debt was immediately written off. How did you do that? What did you say? We said bad debt. That should be bad debt. So we have the budget, 20,300, 16 over 116. So what do you have? So what is the figure for that? It is 2,800. So say 2,800. So then we have lastly, so there's no marking for that. We have what we call exempt sales. So exempt sales, we head to 50. We have a dash and dash. So then we have what we call total output VAT. What is the total output VAT? What is the total output VAT? Give me the total output VAT. So give me what I call the total output VAT. So somebody has it as 28 to 40. So the marking point is the entries, those entries. The marking point should be the entries. So in this case, we said that we restrict because we cannot track, we cannot basically track sales. We cannot track purchases that were sold as exempt. So we do what? We restrict altogether. We basically restrict altogether. We basically restrict altogether. So when you're restricting, we're saying taxable supplies, over what they call the total supplies times what they call them the total input VAT times the total input VAT times the total input VAT. Allow me to adjust the camera. Allow me to adjust our camera. So that should be okay. So we're saying when we're restricting, number one, when restricting, taxable supply, we understand is 0 rate, 0 plus standard rate. Are we together? When you talk about taxable supply, total supplies, that is standard rate plus the 0 rate plus what you call exempt. Is that noted at the back of our mind? When you talk about taxable supplies, that is the 0 rate, plus the standard rate. And when you talk about the total supplies, that should be the standard rate plus zero rate plus exempt. Together, team. If you're together, we respond with yes. Kindly give me yes if you're together. While we're doing this, as an end B, while we're doing this, we are basically saying that the standard rate cells, we're saying that the standard rate cells, we say should be exclusive. It should be exclusive of what we call VAT. While we're doing that, we're saying that the standard rate cells should basically be exclusive of what we call VAT. While we're doing that, we're basically saying that the standard rate cells should basically be exclusive of VAT. Are they exclusive of VAT when you talk about the standard rate cells? Is it exclusive of VAT? Is it exclusive of VAT? No. So where are the standard rate cells? Local cells, this is standard rate at 16, standard rate. Another standard rate cells, Nigapi, we have it here, standard rate altogether. So it's affected by credit note and it's affected by bad debt. So what is the total standard rate cells? So the total standard rate cells should be a figure of 189.60 plus a figure of what you have as 64.960. What is the total standard rate cells? What is the total standard rate cells when you add those two? When you add those two, what is the total standard rate cells? When you add those two, what is the total standard rate cells? What is the total standard rate cells? What should be the total standard rate cells? Total standard rate cells. So that we have it as 245. Somebody gets me 245,920. 245,920. And we adjust it. We adjust this figure, 245,920. We adjust by lessing the credit note, which is 20,880. We adjust it by lessing 2,300. So when you adjust this, what is the net figure? So what should be the net figure when you adjust those two? When we adjust those two, what should be the figure? When you adjust those two, what is the figure? When you adjust that, what is the figure? So we have 204, 204,8, and somebody just to confirm that. Somebody to confirm what T has done and what, somebody to confirm what T has done. Which is which? Is it 740? 740. So that should be, we have it as 740. So we're basically saying that this figure, 204,740, is basically 116% because that's inclusive. Yes, equals to 116, 116. What about the figure exclusive of VAT, which is 100%? So 100% would be 100 over 116 times 204,740. So what is the figure exclusive of VAT? The figure exclusive of VAT equals to that. So what is that figure? So we have 176. We have a figure of 176,500. So we can get the taxable supplies. So taxable supplies should be the standard rate, which we have 176. Zero rate nigani nagani. Remember, this is zero rate. So we have for 80,000. And the next zero rate is 240. So this is zero rate. Zero rate. This is also zero rate. So what is the total taxable supply? 240. Taxable supplies. What is the figure for the taxable supplies? The figure for the taxable supply. Give me the figure for the taxable supply. Yes, plus this. What do you have? Plus that, what do you have? So that is, we have a figure of 896, 500. Can I wrap this part in the middle, the input? Can I wrap the input? Perfect. So then we get the total supplies. We get the total supplies. So we get the total supplies. So we understand that the total supplies, we get the total supplies. Total supplies should now be standard rate, 0, and exempt. So standard rate, we know, is 176,500 plus 720 plus 720. Exempt, which is exempt? When you pick that question, exempt is which figure? Plus exempt. Exempt, we have 250. But you also have plus 170. So what is the total taxable supply? 250 plus 170. So what is the total supplies? What is called the total supplies? So what is the figure for the total supplies? So we have it as 13,16,500. So we can restrict. We get it now what's called deductible. Deductible or restricted input VAT. Input VAT. So where we say the taxable supply, which is 896,500 over 1,316,500 times. What is the total input VAT that we wrapped here? What is the total input VAT that we wrapped? Total input VAT. Give me the total input VAT. So that is 123,360. So what is the deductible? Give me the deductible input VAT. Get me the deductible. T, 0 rated for 80 plus 240. T for 80 plus 240, that is 720. For 80 plus 240, T for 80 plus 0 rated for 80 plus 240. T, where does 720 come from? The first 0 rated to Egypt was for 80, then 240 to Malawi. So that's where we get 720. So what are we getting as deductible input VAT? Are we getting 84? Are we getting that? 84? Perfect. So then we get the VAT payable, so what we call refundable. So we have output is 28 to 40 minus 84,005. So this is VAT refund. VAT refund. What is the refund? What is the VAT refund? What is the VAT refund? Get me the VAT refund. So the refund should be 55,765. But the key thing is not even the answers, the procedure. So how many marks was that question? How many marks was that particular question? 10. How many entries did you have on those input? Input plus that? 1, 2, 3, 4, 5. Input tulikuwa na ngapi? Yes. Input we had about 7. So any 10 times 1, that should give us the answer. Any 10 times 1. So do you see that this question is doable? Is this question doable? Yes. I want to pick a small question that will be able to do this because I want to discuss. I want particularly to discuss that, and then we go to the tax investigation. I want to try and discuss the remaining part, but I want to give a small question before we go to discussing what is remaining in the handout. Together, team, I want to do a small question. I think we should be able to do that question. Can we? Who has the question? Nani and Aswali. So we can pick on a small question, then we discuss the handout. That's a smaller question. We discuss the handout. We'll pick a smaller question. We'll pick a smaller question. Some of the small questions. So check for me which number. August 22. I know it's a smaller question. August Ambuche, are you in class today? Gilbert, are you in class? So August, check a question in August. That is August 22. And tell me which number is that? August 22. I know it's a smaller question. We do that smaller question as the third. That smaller question as the third. As the third. That smaller question as the third. So which number is the particular question? Question 4B. So all of us to open that question. All of us to open that question. Are we there, all of us? As Walimu is opening his question. Are we there? Perfect. So we can do that. So we have it there. So we're being told that Zawadi as a sheet. Is this Zawadi as a sheet? Zawadi as a sheet. Is it that? Is it that? So being told that Zawadi as a sheet provides what we call consultancy. Zawadi as a sheet provides what we call consultancy services. Provide what we call consultancy services to various clients whose terms of contract allow clients to pay for services either before or after provision of service. Before or after provision of service. The following information is provided regarding firm's transaction for the month of October, regarding what we call the firm's transaction for the month of October, November, and December. So number one is audit for XL Supermarket. So the value of service is basically, value of service is 700,000. And the service provision date is 20. Service provision date is 25th October 2021. Then the payment date should be 5th November 2021. Are we able to see that? That is perfect. So then the next thing to the training to Kyle Security. The figure is 3rd November 2021. and you say not yet paid. Not yet paid. 3rd November, and you're being told not yet paid. Not yet paid. So then we have next is accountancy. Accountancy. We have what we call Watoto. We have what we call Watoto. We have what we call Watoto. Accountancy for Watoto Children's Home. The figure is 600,000. The figure is 600,000. That is for December. That was provision date is provision date. That is 5th December 2021, and payment date was 20th November 2021. Is that noted? Is that noted? So what do you think this question wants to test online? Partially or wholly? That should be the tax point. Partially or wholly? That should be the tax point. Tax points altogether. So the next we have debt collection services to Zuela. The figure is 820. That is 9th November, and payment is done. And payment is done. Yes, the earlier when the invoice is issued or payment is done. Perfect. So debt collection to services to Zuela. The figure is 820. That was the service provision was 9th of November, and payment date is 30th September. I hope you mark those dates. So then we have strategic planning. Strategic planning. Strategic planning. We have development. Strategic plan development. Bazon. The figure is 2,115,000. The service date is 10th November 2021, and you're told not yet paid. So then you're being told that management consultancy. Look at the management consultancy. Shylock investment. The figure is 1,440,000. The service provision date is 13th November 2021. 40% was paid on 13th November. 40% of that amount was basically paid on 13th November 2021. Then you have what we call internal review. Next is what we call the internal review. Internal control reviewed, Lema Limited. The figure is 960. The service provision date is 18th November 2021. So 10% paid on October. 10% was actually paid on October. 10% was actually paid on October. 10% was basically paid on October 7th, 2021. Then you have the next, what they call financial consultancy to W Limited. Financial consultancy to W Limited. The figure is 1.2 million. The service provision date is 20th. The service provision date is 20th November. The payment was done on 1st December 2021. Together. Up to that point, are we together? I just want you to mark those dates. Just mark those dates. The key thing is just to mark those dates. So then the next we're being told the Shylock investment. We're being told Shylock investment. Shylock investment. We say it was declared bankrupt. Shylock investment was declared bankrupt on 30th November 2021. If Shylock investment was declared bankrupt on 30th November 2021, what happens to Shylock? If it was declared, remember they're not paid only, but they paid partially. So what happens if it's declared bankrupt by 30th? What happens if they're declared bankrupt? What happens? That becomes what's called a bad debt. That becomes a bad debt. So then you're being told that on 5th November 2021, the Zawadi Associate renewed It's national industrial training license of 30, national industrial training license of 30,000, and paid a legal fee of 360 to follow up on clients who are not paying as per the agreed dates. Those two things, what do they touch on? And Aziz, Chengo, Miriam, what do they touch on? Those two things, what do they touch on? Those two things, they touch on input. Those two things basically touch on input. So then we move to the next, paid electricity. We say electricity paid on November. Electricity paid on November 2021 was 270,000, out of which 100,000 was payment for outstanding, out of which 100,000 was payment. Have you marked those two? Have you marked those two? Have you marked those two? Have you noted those two things? Do we claim VAT on electricity? That is the question. Do we claim, is there an input VAT on electricity? We respond, yes. But mark, as we come back, as we analyze, mark that 100 was for October, 20 was in respect to additional deposit. Just mark them there. So then we have fuel consumed for partners. So say fuel consumed for partners, vehicle amounted, fuel consumed for partners' vehicles, partners' vehicle amounted to 90,000 during the month of November. During the month of November. During the month of November. Yes. Yes, for October. But just mark it. I've not said anything. I've just said, Aziz, I've just said mark it there. October, 100 is for October. Just mark it there because we are doing that. Mwalimu is actually coming back and explain some concept there. Then you say the next, fuel consumed for partners vehicle amounted to 90,000. For partners vehicle amounted to 90,000 during the month of October. During the month of October. What is that? During the month of November, sorry. During the month of November, sorry. During the month of November, mark that. Then you have computer purchase for business. For business use, cost to 40 in November 2021. What is that? Just tell me what it does. Not much. What is that? Computer purchase for business for use, cost to 40 in the month of November. So then we have the next. Zawadi Associate paid rent for the month of November 2021, amounting to 180 on November 5th, 2021. What is that? Paid the rent for November. That is on November 5th. What is that? That's an input altogether. That's an input. So then required, before I give you a small break, I'm coming to one by one. So transactions are stated inclusive of VAT at the rate of 16% where applicable, unless otherwise stated. What do you mean? Transactions are stated inclusive of VAT at the rate of 16% where applicable. Where applicable. Transactions are stated inclusive of VAT where applicable, unless otherwise stated. Together. So what do we use? What do we use? 16. Aziz, also mark the word partners via vehicles. Also mark the word partners via vehicle there. So then, as we go for a break, the examiner tells us altogether, compute the VAT payable buy or refundable by Zawadi Associate for the month of November. That is what you're coming to do. How many minutes break, Tim? You come back when you're fresh. How many minutes break? How many minutes break? We can make it 8. Somebody says 10, so we get to the middle, 8. So come back when you're fresh, then we start that together. Perfect, if you're ready. So 𝐁𝐋𝐻𝐧𝐿. I want to analyze this as we move slowly by slowly. So we start with the output VAT. Output, VAT. I hope everybody's fresh. Is everybody fresh? I took a break because just to engage. So item, so what we call nature of supply. Amount. We have VAT rate, and then we have the VAT together. So I start with these cells. Let's look at the first one. Look up, Tim. I want you to be very keen. And the concept is basically on the tax point. All of us, are we alert? Miriam, are you there? If you're there, you just give me a yes. If all of us are alert, then we... So we look at the first one. So being told that audit service to Excel Supermarket, the value was 700,000. The service provision was 25th October. So what is the tax point? Our focus is November. So when you're told that the service provision was 25th and was paid, what was the tax point? The invoice was basically delivered because the service was provided in October. So for audit of Excel is not in November. Are we in agreement? So the tax point for Excel is October and not November. Give me a yes if you're together. So the service was actually offered on 25th. So I'm saying when you look at the Excel Supermarket, so the tax point is basically October. But our focus is what? Is November. Are we together? Respond with a yes if you're together. Respond with a yes. So don't include Excel. So number 2 is training service to 𝐁𝐿 Security. The figure is 240. The service provision date is 3rd and is not yet paid. So what is the tax point? The service was provided in October. We say whether the service was offered in November. So the tax point for 𝐁𝐿 Security is November. So that is basically November. So we go to training service to 𝐁𝐿. We call it training service to 𝐁𝐿. We have the training service to 𝐁𝐿. The figure is 240. So 240. What do we use? We use what? The services are inclusive of VAT. Inclusive of VAT. So that should 16 over 116. What is the VAT on that? As is, what is the VAT? VAT is for that. So we have 33. Somebody say 33, 103. Is that the answer? Perfect, if that is the answer. So then you're being told that accountancy service to Watoto Children's Home. Watoto accounting services to Watoto Children's Home. How do we treat that? I know somebody, how do you treat that? Is it vatable or not vatable? Very fast. Vatable, that's basically vatable. We are not told that's a registered altogether. So that is accountancy. We know that accountancy services, Watoto. We have it as Watoto Children's Home. When was the service provided? That is vatable. The service was basically provided in December, but the payment was made 20. So the tax point look up. The services to be provided in December. What did you say about tax point? When services are delivered or payments are made. So what makes it to be in November? Because the payment was actually made on 20th November. So the tax point is what? The earlier. Either when the service is delivered or when payment is made only or. So it came earlier. So the tax point is November. Is that okay, Aziz? Tax point is the earlier of the two. Whether the date that the service was done or when payment was made partly or only. So what is the tax point? So for our total is November. Are we in agreement, team? Match in order, perfect. So that is 600,000. It's a good question. I didn't think it was this good question. 116. And that question has not come for long. So something of the sort. This can be tested. There's a likelihood, so that just to give you a fresh perspective. So what is the value? What is the value? So what is the value? So 80, confirm. 82,759. 82,759. So 82,759. So then you're again told that debt collection, we are told debt collection, services to the dweller. The figure is 9th November, it was paid. So debt collection, what do you call the debt collection? Collection services. Debt collection services to Zuela computers. Debt collection services to Zuela. So why November? The services were November, that should be 820, 16 over 116. What is that? Give me that. So give me that debt collection. So the tax point is November because the services were delivered in November. So either the annual, the date when the service was delivered or payment was made. So that is 113, 113, 103. 113, 103. Then we have what we call strategic planning, strategic plan development. Remember Basel Rwanda. What is that? When you say Basel Rwanda, what is that? When you say Basel Rwanda, what is that? What is that? There's a word in the bracket. Basel Rwanda Limited. That's an export. That's zero rated. So we say strategic plan. We have it as strategic plan. We have it as Basel, and we understand that this is Rwanda. Basel, and this is Rwanda. Basel, that is Rwanda. So that was November. The tax point is November, 2115, and then we have 0. And I insist, when you multiply this by 0, don't put a dash. A dash would be wrong. So you have to write what? 0. Together as this, you must write a 0. If you leave a space, it's not a mark. If you put a dash, it's not a mark. Then I forgot to tell you something. Sometimes most of the students, the bad debt, I know you can find conflicting view on bad debt. And those approaches have been harmonized. I'm talking about bad debts. Are we listening? So bad debt, you can less it after getting the VAT payable, then you less bad debt relief. I'm saying some people will teach you in such a way, they'll tell you that for the bad debt, you less it after getting VAT payable or refundable. Or some people do it in the question. The whole those concepts, when you use them, it will still work. Together, team, it will still work for both cases. It will still work for both cases. The people who do not want to less it when you're doing the sales. But in both cases, I'm saying it will work. Is that noted? In both cases, it will work. Oh, perfect. In both cases, whether you see somebody teaching and is getting VAT payable, then it comes and say bad debt relief, both cases will still work, and there's no issue with it. Still get your mark. So then we move to the next. We have what we call consultancy. We have management consultancy, Shylock. 13th November, 40% was paid on 13th. So we have what we call management. We call it management. We have it consultancy, Shylock. And our students are understanding the tax point. Tax point, the earlier, either when the service was done or when payment is made. That will stand as a tax point. So the management of Shylock falls in November. Is the tax point November? Why is the tax point November for Shylock? Give me a yes. Yes, perfect. Because the services were given in November. So that's 14, 16 over 116. So give me that. 16 over 116. Give me that 16 over 116. The earlier of either payment, if payment comes first, that is the tax point. If services, don't worry about that. 40%. Whether credit at that point, we are not told. We have not gotten to additional information. As is, we have not gotten to additional information. Not one? Yes, not. We will get to that on not one. So just give the whole figure. What happens? You get the tax for all. So that's 198. 198. What is the figure? 198, 621. 621. Together. I'm getting to that additional information. Respond with a yes. So don't worry, hold it there. Hold it there. I'm getting to that additional information, number one. So that's together. Then you have what we call the financial. We call it internal control. Internal control reviewed by Lemma. That was 960. The service provision is 18, and payment was done in October. What is the tax point? Is it October or November? That is for internal control for Lemma Limited. For Lemma Limited, Sheila, what is the tax point? We're saying the either of when service or supply was done or when payment is done. What is the tax point for Lemma? That is the financial internal control review. Is it November or October? It is October. October. I have a beautiful class. Either, which one comes first? That's what defines the tax point. So that is not included. So then you have what we call financial consultancy. The figure is 1.2. The service was done on 20th November. If the service is done on 20th November and it's earlier than when payment was done, so the tax point is November. So we have financial consultancy. We have what we call financial consultancy. Financial consultancy, 1.2. We have it as 16 over 1. So get for me that. Get me that. Financial consultancy for W Limited. For W Limited. So 165. We have it as 165. 517. So then we can, I said the bad debts, you can get this and you less it after getting the V. But in our case, we can put the bad debt. We just put it bad debts. What is 60%? Get for me 60% of 1.4, 1,440,000. What is 60% of that of this? 60% of 1,440,000. 60% because the bad 60% times. What is 60% of that? So that should be 864. So 864K times 16 over 116. Get for me that for the budget. So that is 119. We have it as 119, 119, 172. So what is output, total output VT? So get for me the total output very fast. Total output VT. Get me the total output VT. Good students, get me the total output VT.